Okay, so you've brought us a real treat this time, diving into Seth Klarman's Margin of Safety. It's a legendary book for a reason, isn't it? Packed with some really timeless wisdom on investing.
Absolutely. And for you, the learner, maybe you haven't wrestled with this out-of-print classic yourself. It's notoriously hard to get hold of, but we're here to really extract the most crucial insights.
Yeah, think of this as kind of your guided tour to understanding Klarman's core investment philosophy.
Exactly. We're trading a shortcut, sort of to grasp his perspective on building wealth responsibly.
So our mission today is pretty straightforward, right? We want to pinpoint where Klarman believes most investors really go astray,
Uh-huh.
and then lay out the fundamental principles of value investing that he champions as, well, a much sounder strategy for achieving lasting success.
Yeah, just nailing down how he sees things differently.
Okay, let's jump right in then. Klarman kicks things off by drawing a really sharp line between investing and speculation. That distinction, he believes, is absolutely critical, but it gets overlooked a lot.
Oh, definitely. He even quotes Mark Twain, the famous line, "There are two times in a man's life when he should not speculate, when he can't afford it, and when he can."
Huh. And that kind of sets the tone, doesn't it? Highlights the danger right away.
It really does. Klarman sees truly understanding this difference as like the first step to investment success. It's not about chasing quick fads or, hoping for a lottery win.
Right. It's about something more substantial.
Precisely. And to really hammer home the difference, he uses this great little story about trading sardines. You remember that one?
Oh, yeah, vaguely. Paint the picture for us again.
Okay, so the story goes, back when sardines mysteriously vanished from their usual spots off Monterey, California, commodity traders started aggressively bidding up the price of canned sardines. The price just kept climbing and climbing, classic bubble behavior.
Okay.
But then supposedly one buyer decides to actually open a can and, well, eat the contents.
Oh dear, can see where this is going.
Yeah, he got sick, and he complained to the guy he bought it from. But the seller just replied, "You don't understand. These are not eating sardines. They're trading sardines."
That is perfect. It just captures it, doesn't it? The value wasn't in the actual sardines, the product itself. No, it was purely in the expectation that some other fool would pay even more for the can later on. That's speculation, pure and simple.
Exactly. And Klarman uses this to show how so many people approach the stock market. They treat shares like, I don't know, poker chips or something. It's tickers to be flipped.
With little or no thought about the actual business behind the ticker.
It becomes this game of trying to find a greater fool to buy your overpriced asset. So the key takeaway here for you, the learner, is don't just buy something because the price is going up. Always ask, what is this thing actually worth?
Which, as Klarman emphasizes, is a really dangerous game to play. You might find that greater fool.
Or you might be the last one holding the can of bad sardines.
Exactly. Holding the bag.
And this is where value investors really differ, isn't it? Totally. Klarman stresses they focus on the financial reality of the companies, the actual numbers, the business prospects. Speculators, they're just riding price waves.
And he points out that because so many people are speculating, the underlying business value doesn't always, immediately control the price swings. Prices can get...
For sure. Which underscores why we, as people trying to understand the real value, need to be super careful. Steer clear of stuff that just seems way overpriced and depends only on finding that next bigger fool.
Does he give any historical examples of this kind of frenzy?
Oh yeah, he gives a few good ones. Remember the boom in Winchester disk drive manufacturers back in the mid-'80s?
Refresh my memory on that one.
Okay, so in 1983, the market collectively valued just 12 publicly traded, venture-backed Winchester disk drive makers at over $5 billion.
Wow. For disk drives back then.
Yeah. And interestingly, there was a Harvard Business School study around that exact time that specifically warned the industry's actual business prospects just couldn't justify those crazy high valuations. Not then, not ever, basically.
So it was pure market hype driving those prices, like a zero grounding in reality.
Pretty much. The study predicted, maybe a few might succeed, but most were going to struggle or fail. And the gains from the winners wouldn't even cover the losses from the losers.
Classic speculative bubble setup.
Textbook case. Klarman calls them classic trading sardines. And surprise, surprise, the bubble burst. Their total market cap collapsed from $5.4 billion down to just $1.5 billion in, a little over a year.
Ouch. That's a powerful lesson in how quickly that kind of speculation can unravel. He also talks about the Spain fund, right?
Yep, in 1989, this was a closed-end mutual fund investing in Spanish stocks. Initially, its shares traded pretty close to their net asset value, the actual value of what it owned.
Okay, makes sense.
But then, fueled by speculative buying, a lot of it from Japan apparently, the share price soared to more than double its underlying value.
Whoa. So again, completely disconnected from the actual worth of the investments inside the fund.
Totally untethered. Another example of price just floating off into fantasy land. And he even brings up a really surprising example. 30-year U.S. Treasury bonds.
Wait, treasury bonds. Aren't those supposed to be like the definition of safe long-term holdings?
You'd think so. But Klarman points out that at the time he was writing, the average holding period for bonds with maturities of 10 years or more was just 20 days.
20 days for a 30-year bond? That's insane.
Right, that's not investing in any meaningful sense. That's just pure gambling on tiny short-term interest rate movements.
So people were just flipping bonds like they were, well, trading sardines again.
Exactly. No intention of holding to maturity. It just shows how widespread that speculative mindset can become, even in supposedly safe parts of the market.
Okay, so then he brings in Benjamin Graham's famous idea of Mr. Market. How does that fit in?
Well, Klarman reminds us that some speculators make the mistake of looking to Mr. Market's daily price swings, his moods, as a guide for what they should do.
Price goes down, they panic and sell. Price goes up, they get FOMO and jump in blindly.
Assuming the market somehow knows something fundamental that they don't.
But the crucial point, and Graham's whole point, is that Mr. Market is, well, kind of manic depressive. His mood swings reflect crowd psychology, not necessarily the real intrinsic value of the business.
Precisely. Emotional investors and speculators often shoot themselves in the foot. It's the disciplined investors, the ones who can actually use Mr. Market's irrationality, buying when he's depressed, maybe selling when he's euphoric, who have a much better shot long term.
Yeah, because security prices can bounce around for all sorts of reasons.
Totally unrelated to a company's actual health or prospects. That's why Klarman keeps hammering home. Look beyond the price ticker. Look at the actual business.
And he also tackles that flawed strategy of reaching for yield, right? When bond yields are really low.
Oh yeah, that's a classic trap. Investors see pitiful returns on safe bonds and think, okay, I gotta get more return, I'll jump into stocks.
Seems logical on the surface.
But what they often forget or ignore is that the stock market also knows bond yields are low. That information is usually already baked into stock prices, often meaning they're pretty high.
So rushing into stocks just because bonds aren't paying much often means you're buying near a market top.
Exactly. Not exactly a free lunch, as Klarman puts it. It's often a recipe for disappointment.
Definitely not. Okay, one more pitfall he debunks.
The
simplistic idea of just buying stocks with low price to earnings ratios, the low PE strategy.
All right, the thinking is, hey, low PE must be cheap, good deal. You're paying a low multiple for the company's past earnings.
Sounds reasonable.
But Klarman warns that's like driving while only looking in the rearview mirror. A low PE ratio often exists for a very good reason.
Which is
that the market has already sniffed out that those E's, the earnings, are probably going to fall off a cliff.
So the PE looks low based on past earnings, but not based on future earnings.
Exactly. So those cheap stocks might just see their PE ratios shoot up simply because their earnings collapse. The E shrinks faster than the P.
Got it. So for you, the learner, the big takeaway here is always dig deeper. Simple ratios aren't enough. You need to understand the why behind the numbers.
Absolutely critical.
So understanding this core difference between investing and speculation and steering clear of these common mistakes that really forms the bedrock of Klarman's thinking. Okay, so we know some ways investors mess up on their own. What about negative influences from outside? He points a finger squarely at Wall Street itself, doesn't he?
Oh, he does not pull any punches there. He basically argues that Wall Street's entire compensation structure, how they make money, is just really with inherent conflicts of interest.
Conflicts that incentivize.
Then what exactly? Activity. More trades, more deals, more new products. Not necessarily achieving the best long-term results for the clients.
Okay, that's a strong claim.
It is. But his point is, you, the learner, need to be really aware that Wall Street's interests and your interests, they're not always perfectly aligned. You gotta question the advice you get.
Explain that conflict a bit more. It's not like everyone's deliberately giving bad advice, is it? Or is it just the system?
It's largely the system, the incentives. Think about how they traditionally get paid, upfront fees and commissions, Brokers get paid per trade, win or lose for you.
Right, the commission structure.
And investment banks, they rake in huge fees for underwriting new securities IPOs, bond issues, long before anyone knows if those deals will actually work out for the investors who buy them.
So the incentive is just to keep the machine churning, keep the deals flowing.
That's the core of it. The focus is often on generating activity, generating those fees, not necessarily ensuring the best long-term outcomes for you, the investor.
And he talks about brokers pushing high commission products.
Yeah, he highlights that conflict where brokers might be encouraged, subtly or not so subtly, to sell securities that generate higher commissions for them and the firm.
Even if something cheaper, like a treasury bill or a no-load fund, might actually be better for the client situation.
Exactly. And he even mentions the really unethical practice of churning just excessive trading in an account purely to generate commissions.
That sounds awful.
It is. And these conflicts aren't just with brokers. Think about securities underwriting. Those massive fees can tempt firms to bring deals to market that are maybe overpriced or maybe riskier than they let on.
So they're favoring the company issuing the stock or bond over the investors buying it.
It can certainly lean that way. The issuer is paying the big fee, after all.
And he argues merchant banking is even worse, where the Wall Street firm uses its own money.
Yeah, because then they become direct players, buying and selling whole companies. This puts them in direct competition sometimes with their own clients who might be looking at the same deals.
So your advisor's firm might actually be bidding against you. That's a clear conflict.
A very clear conflict. It really makes you think about whose interests are truly number one.
It does indeed.
And because these firms act as both the creators of new securities, investment banking, and the distributors, brokerage, they have this built-in incentive to create their own products to sell.
Like new stock offering or bond issues that they underwrite.
Exactly, because those generate the really fat fees. And the brokers get a nice cut for selling these new issues, usually a much higher commission than they'd get for just facilitating a trade of an existing stock in the secondary market.
It uses closed-end mutual funds as an example of this, right? How they get launched.
Perfect example. These funds often come out at, say, $10 a share. But maybe there's an 8% underwriting fee, so only $9.20 actually goes into the pot to be invested. But then pretty quickly, these funds often start trading in the market below that $9.20 net asset value. So if you bought at the $10 IPO price, you're underwater almost immediately. Ouch.
Because of those fees.
And largely because of those fees. Klarman points out you could often get similar investments more cheaply through existing no-load open-end funds, which don't have those big upfront sales charges and always trade at their net asset value.
It just keeps coming back to that short-term focus, doesn't it? Driven by the immediate fees.
That's his argument. Brokers, traders, investment bankers, they're naturally focused on the next transaction, the next fee, maybe not the long-term impact on the client.
He even mentions that equitization wave in the early 90s.
Yeah, that was a classic. Lots of companies had been taken private in leveraged buyouts using junk bonds. They were drowning in debt.
Okay.
So Wall Street firms collected huge fees first when arranging the buyouts and loading them up with debt. And then they collected more huge fees when they brought these same companies back public, issuing stock specifically to pay down all that debt they'd helped pile on. Well,
talk about getting paid twice for the same mess. Double dipping indeed.
Pretty much. And he suggests, look, some people on Wall Street are just focused on making a quick buck, maximize their income for a few years, then maybe move on.
Or maybe they're just uncertain about their own job security, so they grab the cash while they can.
Could be that too. Less focus on building long-term relationships, more focus on immediate compensation. It paints a picture where the client's long-term success can sometimes take a back seat.
It's a bit cynical, but probably realistic in some cases.
Now, Klarman does acknowledge, there are people on Wall Street with a long-term view who really prioritize clients. It's not everyone.
Okay, that's fair.
But he thinks many operate under the assumption that clients will turn over anyway, so they might as well maximize the short-term commissions. It becomes a kind of self-fulfilling prophecy.
And Wall Street overall tends to be bullish, right? They like rising markets.
Oh, absolutely. Rising markets mean more IPOs, more bond deals, more fees. Plus, clients are happier when their accounts are going up, less likely to complain or leave. Even the inventory of securities the firms hold goes up in value.
So we should take those optimistic forecasts from Wall Street analysts with, what, a grain of salt.
A healthy dose of skepticism, absolutely. Understand the inherent bias towards optimism.
He also talks about financial innovations. Are new products always good for investors?
Not necessarily. Klarman argues that while some innovations do solve real problems, Often, they mainly benefit Wall Street by creating new things to sell and generate fees from.
So the intermediaries, the banks, and big institutions often get the biggest benefit without taking much risk themselves.
That's often the case. They create complexity, trade it, make fees, but the ultimate risk might sit with the end investor who doesn't fully understand the newfangled product.
He mentions all those new debt and derivative securities from the 80s.
Exactly. Fixed rate, floating rate, zero coupon, convertibles, a whole alphabet soup. He points out that some, like auction rate preferred stock or zero coupon junk bonds, basically blew up and cost investors dearly.
Right, they didn't work out so well.
At others, maybe they worked as designed, but didn't really offer much lasting value to the average person.
What about those IOs and POs, the mortgage things? Interest only and principal only.
Yeah, those were created by slicing up the payments from mortgages. Klarman uses them as an example of how financial engineering, making things more complex, doesn't always add value. Sometimes splitting things apart can actually make the pieces worth less combined than the original whole.
Like the sum of the parts being less than the whole.
Exactly. Imagine trying to sell the rights to just the interest payments on a loan separately from the rights to the principal repayment. It gets complicated and might not be as valuable.
So complexity itself isn't value. It sounds like we need to be wary of things that seem overly complex just for complexity's sake.
That's a great way to put it. He then broadens this idea to investment fads that go beyond just one security type. Entire industries can become Wall Street darlings.
Like energy, tech, biotech. They all have their moments in the sun.
Right, and Wall Street makes a killing issuing stocks and bonds for these hot sectors. They profit hugely from the initial surge, even if investor enthusiasm eventually fades and the share prices collapse later on.
So the danger isn't the trend itself, necessarily, but when the prices get way ahead of the underlying business reality.
Precisely. Telling a real trend from a fad is tough, no doubt. But the key danger point Klarman highlights is when prices get driven up to levels that just aren't supported by any reasonable analysis of the actual business value.
Okay, so Klarman's conclusion on Wall Street is pretty stark. Their primary focus is often self-interest and short-term gain. Investors need to be constantly on guard.
It's definitely a sobering perspective, but a really important one for you, the learner, to keep in mind as you're navigating all this.
It certainly is. Okay, moving on from Wall Street itself, Klarman then turns his critical eye to another huge force in the markets: institutional investors. Pension funds, mutual funds, endowments.
Yeah, he looks at this massive shift since World War II. Back then, individuals dominated. Now, it's the big institutions fueled by all our retirement savings and whatnot. They count for, what, something like 3/4 of all stock trading volume now?
That is a staggering amount of market influence. So what are the potential problems Klarman sees with these big players? He's quite critical, isn't he?
He really is. He describes their behavior as, and this is his word, horrifying sometime.
Horrifying, yeah.
Because they often move enormous sums of money based on surprisingly little independent research. There's a huge pressure to just go along with the crowd, with what other institutions are doing.
Why? To avoid looking bad.
Exactly. It's about prioritizing consensus over independent thought. The main goal often becomes avoiding underperforming their peers or their benchmark index, even if that means settling for mediocre results overall.
So it's less about getting the best possible return for their clients and more about not being the worst performer in the group.
That's the crucial distinction he makes. This short-term relative performance focus is so common that Klarman argues the very term institutional investor is almost a contradiction in terms, an oxymoron.
Because true investing is long-term and absolute, not short-term and relative.
That's his view. Their primary goal often becomes just not sticking out negatively in the quarterly performance rankings. This leads to that follow the leader or herd mentality into whatever stocks or sectors are currently popular.
And how they get paid probably feeds into this too, right?
Absolutely. Most money managers get paid based on a percentage of the assets they manage, not how well they actually perform. AUM fees, they call them.
Assets under management.
Right. So the incentive is to gather more assets, make the fund bigger and bigger, because that directly increases their fees.
Even if managing vastly larger sums makes it harder to actually find good investments and generate strong returns.
Exactly. It gets much harder to outperform when you're managing billions versus millions. So there's this inherent conflict. The manager wants asset growth for their own paycheck, but that growth can actually hurt the performance potential for the clients. Klarman thinks this conflict often gets resolved in the manager's favor.
And he also talks about the pressure just to keep clients happy, or at least not lose them. That must influence decision.
For sure, clients, especially institutional clients, can be quick to fire managers who lag behind the pack, even for short periods. So most managers feel safer staying close to the average. Don't rock the boat.
So even if you have a really great unconventional idea, it feels risky.
Very risky, personally and professionally. If your contrarian bet goes wrong, you look really bad really fast. You might lose your job or your clients. So sticking with the herd and achieving merely average, mediocre performance often becomes the safer career path, sadly.
And the way decisions get made inside these huge organizations probably reinforces that conformity, like investment by committee.
Definitely. Klarman points to bureaucracy, inertia, maybe even excessive diversification, owning a little bit of everything just to avoid tracking error as common results. If you're an analyst inside a big firm pushing a truly contrarian idea, you're taking a big personal risk.
So it discourages real innovation and encourages just holding on to whatever everyone else holds, even if it seems overpriced.
Pretty much. It makes them reluctant to make truly unconventional bets and maybe slow to sell things that have run up but look overvalued, because selling too early also looks bad relative to peers who are still holding.
He also mentions diseconomies of scale. What does he mean by that?
Just that as the pile of money gets bigger and bigger, the return you can generate per dollar tends to go down.
Why?
Because truly great investment ideas are scarce. You can't just keep finding amazing 50-cent dollars indefinitely as you scale up to managing tens of billions. This often forces big institutions to focus only on the largest, most liquid stocks, the mega caps, because that's the only place they can deploy huge amounts of capital without moving the price too much against themselves.
So they ignore potentially better opportunities in smaller companies.
Often, yes. Their sheer size limits their investment universe.
And many of these institutions feel they have to be fully invested all the time. They don't hold much cash.
That's another key point. They often see their job as picking stocks within the market, not deciding whether to be in the market. They assume their clients have already made the big asset allocation decision.
Whereas a true value investor, in Klarman's view, would be perfectly happy holding cash if they can't find anything cheap enough.
Exactly. Absolute performance investors only buy when their value criteria are met. If nothing meets the standard, they wait, holding cash. They don't feel forced to buy something just because it's in an index or because cash yields are low.
He also criticizes how institutions categorize assets too rigidly. Like an equity manager can't buy a bond.
Yeah, that's siloed thinking. An equity portfolio manager might be strictly forbidden from buying, say, the bonds of a bankrupt company, even if those bonds look like an incredible value opportunity.
Or a high-yield bond manager has to only buy junk bonds, even if investment-grade bonds look more attractive at some point.
Exactly. The money is stuck in these narrow boxes. It prevents them from being flexible and opportunistic, from going where the best values actually are across different asset classes.
Okay, then there's something called window dressing. What's that about? Sounds dodgy.
It is a bit dodgy. It's basically making the portfolio look good on paper for the quarterly report that goes out to clients.
How do they do that?
Well, just before the quarter ends, they might buy shares of stocks that have been the hottest performers during that quarter, so those names appear in the holdings list. And they might sell stocks that have done poorly, especially ones with unrealized losses, so they don't have to report holding those losers anymore.
But that buying and selling isn't based on investment merits. It's just for appearances.
Purely for appearances. It's clearly uneconomic, just shuffling the deck chairs to make a report look better. Driven by optics, not value.
And he briefly mentions portfolio insurance. That strategy that failed spectacularly in '87.
Yeah, just as another example of a flawed, overly simplistic institutional strategy that relied on quantitative models based on past volatility, which just fell apart when volatility went completely off the chart.
Okay. And finally, he talks about index funds becoming really popular.
Right. Indexing has exploded. The appeal is obvious. You're guaranteed to match the market index performance minus very low fees.
Which sounds pretty good, especially since so many active managers fail to beat the index anyway.
Exactly. Plus, it aligns with the efficient market hypothesis, the idea that trying to beat the market is futile, so why pay high fees to try? Just buy the index cheaply.
The Klarman isn't a fan of indexing becoming too dominant, is he?
No, he raises some serious concerns. He sees it as potentially self-defeating if almost everyone does it. The whole idea of indexing relies on the market being reasonably efficient, right? But markets become efficient because lots of people are doing research, analyzing companies, trying to find mispricings. If everyone just blindly buys the index,
Fewer people are doing that fundamental analysis.
exactly, and if fewer people are doing the work to figure out what companies are actually worth, the market could become less efficient, not more. Prices could drift further away from true value.
So, paradoxically, too much indexing could undermine the very efficiency it relies on.
That's the potential problem he flags. In an extreme case where literally everyone indexed, prices would just move in lockstep based on flows, with no connection to individual company performance. Think about it. If everyone only read book summaries, who would write the actual books? The summaries would become useless.
That's a good analogy. He also points out weird effects when stocks get added to or dropped from an index like the S&P 500.
Yeah, that's a big one. Because index funds have to replicate the index exactly. When a stock gets added, all the index funds tracking that index are forced to buy it.
Regardless of the price.
Regardless of the price, this creates this huge artificial surge in demand that can push the stock's price way up, just because of the mechanics of indexing, not because anything fundamental about the company changed.
He mentioned Blockbuster Entertainment as an example.
Right. When it got added to the S&P 500, its market cap jumped significantly in a single day, purely due to that forced index buying. Barron's even calculated the effect.
And similar problems happen with small cap indexes, maybe even worse because those stocks are less liquid.
Exactly. Big index funds trying to buy or sell large chunks of small, thinly traded stocks can have a massive impact on their prices, potentially forcing the funds to buy high and sell low just to track the index changes.
And he notes that this whole indexing boom happened during a long bull market.
Yeah, a period where the S&P 500 did outperform a lot of active managers, making indexing look even smarter. It hasn't really been tested in a prolonged, nasty bear market in the same way.
So indexing looks simple and cheap, but Klarman definitely gives us reasons to think about the potential downsides and unintended consequences if it becomes the only game in town.
Okay, let's shift gears again to another big cautionary tale Klarman uses, the junk bond mania of the 1980s.
Ah, yes, the spectacular rise and even more spectacular fall of the high yield or junk bond market. Klarman uses this as just a prime example of how completely misguided investor thinking can grab hold and spread, often with really damaging results.
It was a huge deal in the 80s, right? Really changed corporate America. Oh, massive. He talks about its incredibly rapid growth, how it influenced everything, other securities, how companies behaved, and maybe strangest of all, how it stayed popular even after people started losing serious money.
How to fuel things,
Mm,
just by making debt readily available.
pretty much. This flood of junk bond financing helped push business valuations way up. It led investors to basically ignore or just toss out traditional ways of analyzing companies and valuing them. They adopted new, often unproven metrics instead.
And it started as just Wall Street wanting fees, but morphed into something else.
Yeah, he describes it as starting as a fee-generating exercise, but then becoming almost like a moral crusade.
A moral crusade for junk bonds. That sounds odd.
I know, right? But investors, underwriters, brokers, they all seem to want to believe they could get these much higher returns without taking on much extra risk. The story shifted.
Away from acknowledging the higher default risk.
Yeah, they stopped talking about that and started pitching junk bonds as like the engine of America's economic revival, financing innovative small companies. That was the narrative.
Even though most of the money was probably going to already leveraged companies doing buyouts and things.
That was often the reality, but the narrative was powerful. And the early successes kind of fueled themselves. More cheap, like non-recourse debt became available.
Non-recourse meaning the lender could only go after the specific asset, not the whole company. Less risk for the borrower, more for the lender.
Exactly, which encouraged even more borrowing. And all this borrowed money chasing deals just pushed asset prices higher and higher. It looked like everyone was making brilliant deals, but it was partly a self-fulfilling prophecy driven by leverage.
And then the economy helped out for a while.
Yeah, the mid-80s saw recovery and falling interest rates, which kind of bailed out even some of the really dodgy junk bond deals. This just reinforced that false perception that default risk was super low.
So it created this dangerous positive feedback loop. Easy money, rising prices, low perceived risk, until it wasn't.
Precisely. And Klarman points out the inherent greater fool thinking in buying these very junior pieces of debt in super leveraged companies. You were betting someone else would pay even more later, regardless of the shaky foundation.
He also really rips into the use of EBITDA, doesn't he, as the main valuation metric.
Oh yeah. Heard. Things before interest, taxes, depreciation, and amortization. It became the number everyone focused on for valuing these debt-heavy companies.
But what's wrong with it? It's a measure of cash flow, isn't it?
Sort of, but Klarman is highly critical because it ignores a huge cash outflow, capital expenditures. The money a company absolutely has to spend just to maintain its existing business, fix equipment, upgrade technology, let alone fund actual growth.
So EBITDA makes cash flow look bigger than it really is because it doesn't subtract that necessary reinvestment.
Exactly. It's cash flow before essential spending. The argument back then was, oh, companies can always borrow more money to cover capital expenditures.
Which sounds crazy for a company already loaded with debt.
It was crazy, especially for companies potentially facing distress. They usually can borrow more. Their access to capital dries up. So relying on EBITDA painted this overly rosy, misleading picture of financial health.
So the underwriters, the buyers, they were all motivated by fees and greed, and they used these flawed metrics like EBITDA and claims of low default rates to justify paying higher and higher prices.
That's Klarman's take. They rationalized it. Everyone wanted to believe the story. But then reality hit in 1990. The market turned.
And those junk bonds suddenly became impossible to sell.
Totally illiquid. Klarman famously called them roach motels. You could check in, but you couldn't check out. The optimism vanished overnight, replaced by panic. Everyone suddenly remembered downside risk, and prices just plummeted.
Wow, a really stark lesson about what happens when fundamentals and skepticism get thrown out the window in a chase for high returns. Okay, so we've seen the pitfalls, the bad influences, the manias. Let's get to Klarman's solution: the absolute importance of a margin of safety and the core ideas of value investing.
Right. This is really the heart of the book, his positive prescription. He starts by just emphasizing how uncertain the future is. The economy, inflation, interest rates, wars, pandemics, you name it, we just can't predict it reliably.
So you can't base your strategy on guessing the future correctly.
No, because you'll inevitably be wrong sometimes, maybe disastrously wrong. So, prudent investors, he argues, need to set up their portfolios to survive, maybe even do okay, under a wide range of possible future scenarios, not just the rosy ones.
It's about building in resilience, a buffer.
Exactly, a buffer against the unexpected bad stuff. That's what the margin of safety is. It's insurance.
And he says smart investors are willing to maybe give up some potential upside to get that insurance.
Precisely. Forgo some possible near-term return as the premium you pay for protection against adversity you can't foresee. He also warns strongly against setting a specific rate of return as your main investment goal, like, I need to make 12% this year.
Why is that a mistake? Don't goals help?
Not that kind of goal. Because infinite returns aren't directly controllable, like by working harder. You can't will the market to give you 12%. Okay. Setting that kind of target can make you fixate only on the upside needed to hit the number. You start ignoring or downplaying the risks involved. It can push you to take too much risk, maybe chasing speculative junk, just to try and reach that arbitrary target.
So instead of chasing a return number, the focus should be on what? Avoiding loss.
Yes. Primarily on avoiding permanent loss of capital, and this is where value investing comes in. Klarman believes it's the only approach that really puts loss avoidance first, that genuinely tries to weigh risk against potential reward in a rational way.
Okay, so define value investing again, Klarman style.
In a nutshell, it's the discipline of buying securities only when they trade at a significant discount to their underlying, conservatively calculated intrinsic value, and then holding them patiently until the market price more closely reflects that actual value.
It's the classic buying $1 for 50 cents.
That's the goal. It requires two key things. First, rigorous, conservative analysis to figure out what that dollar is actually worth. And second, the unwavering discipline to only buy when you can get it for that 50 cents, or maybe 60 or 70 cents. That discount is the margin of safety.
And you need patience because those 50-cent dollars aren't always just lying around.
Exactly. Bargains come and go with market moods. You need patience to wait for them and persistence to keep looking. He also stresses that valuing a business isn't some precise mathematical exercise.
It's not like you can plug numbers into a formula and get the exact value.
Definitely not. It's complex. You never know all the facts. The future is inherently fuzzy. Plus, business values themselves aren't fixed. They change with the economy, inflation, deflation, competition.
He mentions inflation and deflation specifically. Okay. How do they affect value investing?
Well, value investing can work fine in inflation, as asset values tend to rise in nominal terms. But the danger is getting complacent, relaxing your standards, overpaying because everything seems to be going up.
Paying 50 cents for an 80-cent dollar, it's really only worth 60 cents because of inflation. something like that.
And deflation is tricky too. Those hidden assets on the balance sheet that value investors love. They might shrink in value or even become liabilities in a deflationary spiral.
So it's not just about buying cheap based on past numbers. You have to understand the business deeply.
Crucial. You need to understand why something is cheap, why you think it's undervalued, and you need a reason to sell too, usually when that reason for undervaluation is gone or the price reaches fair value.
Does he suggest looking for things that might help the market recognize the value, like catalysts?
Yes, he advocates looking for potential catalysts, maybe a change in management, a spin-off, an industry turnaround, things that could help unlock the value you see. He also prefers companies where the managers have their own skin in the game, a significant personal financial stake.
Aligns their interests with shareholders. Makes sense. And diversification. Hedging.
Yeah, he recommends diversifying across different investments. Don't put all your eggs in one 50-cent basket. And consider hedging specific risks if it makes financial sense, if it's attractively priced insurance.
He used that Texaco bond example after the '87 crash, right, as a case with a margin of safety.
Great example. Texaco is in bankruptcy proceedings, huge uncertainty. But their bonds were trading so low that even if things went badly, you might not lose much. And if they were eventually paid off, the returns would be enormous. That gap between the worst-case downside and the potential upside created a margin of safety.
So even with all the computers and PhDs in finance now, Klarman still believes these kinds of significant mispricings happen. He doesn't buy the efficient market theory.
Not in its strongest form, no. He firmly believes mispricings occur frequently enough to make value investing viable. He even points to Warren Buffett's famous essay, The Super Investors of Graham and Doddsville.
Yeah, which showed a bunch of investors who followed Graham's value principles consistently beating the market over decades. Kind of hard for the efficient market folks to explain away.
Exactly. And Klarman argues that there are forces that eventually push prices back towards value. Things management does, buybacks, restructuring, or external things, takeover offers, industry consolidation. Value investing, he says, is like a large-scale, not totally risk-free arbitrage between price and value.
Yeah, but he warns about value pretenders,
yeah.
not people just using the label.
Yeah, especially after genuine value investors like Buffett became famous. Suddenly, everyone wanted to call themselves a value investor, even if they weren't really doing the hard analytical work or demanding that margin of safety that Graham taught.
So you have to look past the label. He also contrasts value investing with top-down investing, right?
Big distinction. Top-down investing starts with a big picture view. I think interest rates are going down or electric vehicles are the future, and then picks stocks to play that theme.
Versus bottom-up value investing,
which starts by analyzing individual companies, looking for specific bargains regardless of the macro picture. Find a 50-cent dollar first, then maybe think about how the economy affects it, but the bargain comes first.
And Klarman clearly favors bottom-up. Why?
He sees top-down as much more speculative. You're betting on your macro forecast being right, and then also betting you pick the right stocks to express that view. Where's the margin of safety in predicting the whole economy? It feels more like a greater fool or maybe greater genius game.
Whereas bottom-up is simpler in concept.
Conceptually, yes. Buy a bargain and wait. The hard part is doing the work to identify the bargain and having the patience.
He also pushes for an absolute performance focus, not relative.
Right. Worry about achieving your goals, meeting your needs over the long term. Don't get caught up in trying to beat the S&P 500 every single quarter. That leads to short-term thinking and herd behavior.
And he really doesn't like the standard definition of risk as volatility or beta.
Hates it. He thinks it's preposterous, actually. Beta just measures past price wiggles relative to the market. It tells you nothing about the underlying business's quality, its balance sheet, its prospects, or, crucially, the price you're paying for it.
So a stock could have low beta, but be wildly overpriced and therefore very risky. Or high beta, but be incredibly cheap and actually quite safe.
Exactly. Risk, for Klarman, is about the potential for permanent loss, which comes from overpaying or buying a deteriorating business. It's not about how much the price bounces around day to day. In fact, price drops can be good for a long-term value investor. They create buying opportunities.
Assuming you had the cash and the stomach for it.
Right. Liquidity is key. Holding cash allows you to take advantage of those market declines when Mr. Market gets irrationally pessimistic. It avoids opportunity cost. He also talks about managing portfolio cash flow through shorter duration bonds, catalyst, or special situations like bankruptcies.
And he keeps reminding us the business value isn't a fixed number. It's fuzzy, it changes.
Constantly. It requires continuous reassessment. And his great line, precise valuations are usually precisely inaccurate. Don't fall in love with your spreadsheet model. Reality is messier.
Okay, and just briefly, he mentions 3 valuation methods he finds useful.
Yeah, just touches on them. Net present value, NPV, discounting future cash flows back to today. Private market value, what would a knowledgeable buyer pay for the whole company, often based on comparable deals. And liquidation value, a super conservative floor, what the tangible assets would fetch if sold off.
Okay, so wrapping this up then. For you, the learner, the really big takeaways from this deep dive into Klarman's margin of safety seem clear. First, be super wary of speculation siren song.
Know the difference.
Second, really understand the potential biases and conflicts coming from Wall Street and the often herd-like relative performance game played by big institutions.
Definitely need that awareness. Be skeptical.
And third, and most importantly, embrace those core value investing principles. Focus relentlessly on the underlying business value.
Yep, did homework.
Demand that significant discount, that margin of safety before you buy.
Non-negotiable.
And then have the patience. Patience to wait for opportunities and patience to let the value play out.
Patience and discipline. They're maybe the hardest parts.
So given all that, all the noise, the short-term pressures we talked about, here's a final thought for you, the learner. What's maybe one immediate action, one small shift you could make today to start thinking more like a value investor, no matter what the market's doing?
That's a great question to ponder. Maybe it's questioning one assumption you hold, or committing to digging just a little deeper on one investment idea, or simply asking, where's a margin of safety here? It's really about cultivating that mindset. Keep exploring these ideas, keep applying them. We're pretty confident those aha moments will come, leading to a much more informed and hopefully more resilient approach to building wealth over the long run.